Thanks for tuning into Insight, a show where we endeavor to give you the insight that you might need to take a smart decision on your portfolio. We'll try and talk over the course of this show to some of the smartest money managers, to some of the most prominent industry experts or companies within the space that we're talking about, so that we can get all the necessary insights to make the right decision. The space that decided to speaking out today is the hotel space. And somebody who tracks this very closely is Abhay Agarwal of Piper Serica. Let me first get him in on the conversation to try and get an overarching view on why is it that he's constructive on this pocket. Abhay, great having you. Thanks for joining in to this debut show of Insight. Lovely having you. Why hotels? The space is no longer at the nadir valuations that it was in September 2020. There's a smart bit of valuation re-rating that has happened. And it almost seems that everybody is greedy about this pocket. So why are you constructive on hotels?
No, thank you, Neeraj and the team at BQ. It's an honor, privilege to be on the debut show. And I wish you guys all the best and, looking forward to many more shows like this. So on hotels specifically, Neeraj, we are very constructive because there has been a complete turnaround post-COVID. And for the last time that the hotel cycle saw an upcycle like this was 2000 to 2008. And it looks like now we have got into probably a better upcycle. The reason being that if you look at the macro level data, at the organized hotel rooms, India has about 160,000 rooms, which is less than 1% of global rooms at 1.7 crore rooms. I mean, China has 40 lakh rooms and we have 1.6 lakh rooms. So there is a huge distance that still has to be covered, so that big macro factor has to be taken into consideration, that the demand is a multi-decadal demand. And at the same time, the supply is highly constricted. 160,000 existing rooms, 40,000 rooms coming up. And, the market is getting more and more consolidated towards larger players. And what this is doing is that there is an uptick in both average room rates and occupancy levels. The occupancy level that the industry has at 65% is probably higher than pre-COVID levels now. ARRs are definitely higher than that. And this is not stopping. You're looking at hotel chains now forecasting a higher than 50% EBITDA margin, which is probably the highest ever. So every which way we look at it, Neeraj, it looks like that pricing power is back because of demand-supply equilibrium changing in the favor of the hotel industry. The macros indicate this is a multi-decadal demand environment. And, as the economy grows, the organized players are going to benefit. And I completely agree with you. Valuations have already priced in. But probably if you look at, valuation 3, 4, 5 years out, this is probably still a good time to look at the sector as a whole.
Okay. Well, I'll try and play the devil's advocate. But what we'll do is over the course of the next 10 to 12 minutes is get in an industry participant to try and give his point of view about which state or where on the cycle is the industry currently, because we know hotels is a cyclical industry, at least used to be in the past. Let me put it that way. Maybe it's a new normal now. Sanjay Sethi of Chalet Hotels joins in right now. Remember, viewers, their model is slightly different than what some of their peers are within the large organized space. But let's welcome in on the show. Sanjay, great having you. Thanks for joining in. At the outset, I would like to ask you a question, and I'm sure Abhay has a few that he would want to ask you as well. But do you sense that, or do you believe that the nature of the dynamics of the industry currently for maybe this decade or the next 4 or 5 years are materially different than what the structure of the industry was pre-COVID? Why?
Good afternoon, Neeraj and Abhay, and thank you for having me on the show. Yes, in some ways it has changed materially. I think next 5 years for sure, we see the operating models are likely to be a lot more different than they were in the past. I think for a very simple reason. During the pandemic, a lot of the prospective hotel projects got pulled out. And the supply side looks extremely weak now for the next foreseeable future. And when I say foreseeable, I mean next 4 to 5 years. And the demand from April of last year has been extremely robust. It's growing in high double-digit rate growths. In fact, we've had quarter-on-quarter growth rates in double digits. So clearly, demand's growing at a very rapid pace. Supply is weak and likely to be weak because it takes years to build a hotel. So from all that perspective, the operations of hotels will adapt to this new scenario where it's a seller's market and adjust to make the most of it at this point of time. The other thing that's happened differently, excuse me, is that during the pandemic, a lot of people looked at their operating costs. And on that front, I think some of the initiatives that have been taken during the pandemic have got institutionalized by a lot of the hotel industry companies. And therefore, the benefit of that will be reaped throughout the next 4 or 5 years.
Okay. A question. So we've seen, obviously, occupancy rates is a different kettle of fish, but ARRs go up quite a bit in the last few months, if you will. Now, I know global comparisons may make India still look cheap, but at some point of time, relative to the per capita of the populace that spends on hotels, would there be an upside cap, Sanjay, to rates in the near future, beyond which demand elasticity might kick in and reduce demand?
So I don't think the demand is going to go down. There is a certain tensility to the rates, and you correctly pointed that out. So will the rates continue to grow at double digits every quarter? No, unlikely to happen. But is it going to be a robust annual rate of growth for the average room rates? I think that's very much on the cards for the next few years. We've got to, number one, counter inflation that's of the last 3 or 4 years. We've got to get rates far higher than they were in 2019-20. And keep in mind that the rates in Mumbai and Delhi, where they are today, are still lower than where they were in 2008, or just about there on where they were in 2007 and 8. So it's not as if they're exorbitant by even the wildest imagination. And when you convert them to dollar rates, less so.
Yeah, I guess so. Abhay, I would have some questions for you, but if you have a question or two for Sanjay Sethi.
Yeah, no, definitely, Sanjay. Thank you so much. Sanjay, right now it looks like that corporate travel is back, big time, and we're seeing that in MICE pickup also. Going forward over the next 2-3 years, which segment do you expect to pick up more? The domestic leisure travel, or will it be international inbound travel, which is still pretty weak compared to pre-COVID levels? Or do you expect the whole corporate travel to pick up the slack? So where do you expect the growth to come from?
So Abhay, what's happened is the leisure domestic travel has been extremely strong for the last almost a year now. And that's sort of likely to stay strong, but probably not grow at the pace that it grew at in the past. Corporate business travel, I'm going to break it up into 2 segments again, the domestic and international. Domestic has been extremely strong, and it wasn't pent-up demand for sure, because pent-up demand doesn't last for 9 months. And it's growing every month. So there's clear great growth in the demand for domestic business travel, much higher than it was in the pre-pandemic, and I think driven on the back of the India growth story. So I see that sort of continue to stay strong in the foreseeable future. And you're right, the international travel is not back to where it was pre-pandemic, and there's a lot of ground to be gained over there. And that's where probably the largest amount of headroom for growth is going to be. And we've got to remember that that segment of the travel is the highest paying customer also. So it stands to benefit hotels in the big cities in the years to come.
One more question, if Neeraj would permit me, is on capital allocation. Now, we've seen this up cycles came last time, and everybody, the large players said, wow, our balance sheets are strong, debt equity is low, demand is strong. Let's commit to more capex, let's build some new hotels or acquire some old ones and put them out. Do you see that happening at some point of time? Just driven by higher profitability, some of the players would come in and change the capex plans and be more aggressive, and the room supply will actually be higher than what it is anticipated to be right now.
So yes, I do believe that there'll be a lot more aggressive growth strategies that will come into play for the established hotel companies, ours included, as we speak. We've got a capex plan which has been pretty aggressive for the last 4 years now. And a lot of that is actually getting completed now. So the benefit of that capex plan is going to come in the next few quarters, whether it was a couple of million square foot of office spaces or 1.5 million rather, or the 1,000 odd rooms that we're planning to build. So all of that combined together will now sort of get to fruition in the next few quarters, except the Delhi one, which will take longer to get ready because that's just started. Similarly, other hotel companies are looking aggressively too, but a lot of them have actually announced asset-light strategies as their way forward. So from that perspective, I don't see too many large hotel companies investing aggressively in greenfield hotels at least, which means the supply will continue to be challenged. And even if today someone decides to invest in a greenfield asset and develop that, it takes anywhere between 4 to 7 years to build a hotel out. Designing, then approvals, then the contracting, and then you have shovels in the ground, and that's when and it takes you 3 years from then to build it out. At a very efficient pace, it will take you still 30 months after that to build it out. So we've got a 4-5 year visibility of fair amount of comfort on low supply. I think the capital allocation will be twofold. One, a lot of the hotels needed some upgradation, and it hasn't happened for 3 years. So there'll be some capital allocation for hotel companies towards upgrading and renewing their products in this competitive space. And secondly, I think growth will be on everyone's mind today, because if people miss the opportunity now, they would have missed the opportunity for the next decade.
No, thank you so much, Sanjay. Neeraj, over to you.
Thanks. Abhay, you can ask in a question if you want to. Of course, we still have 5 minutes with him, but let me squeeze in one on a follow-up to what Abhay just asked, and which is, I'm wondering if the next 5 to 7 to 8 years for chalet hotels, could there be more of what they would have been from an asset allocation strategy, in that when you get higher cash flows, you invest in building up more capacity, whereas in the cases of some asset-light companies that I've spoken to, they are saying that they are going to go out and reduce their debt quite aggressively. Now, I heard you say that you've done a bit of capex, but you do have some aggressive capex plans as well. So for you, Sanjay, would it be more of the same, in that you're getting the cash flows, but you're building up capacity so that you don't miss the opportunity that you just spoke about?
Absolutely. Look, we think the opportunity is now and here.
Okay.
So therefore, it's important to sort of grab that opportunity. We've got significant amount of capex that's been underway for the last 4 years, actually. And therefore, very often we get sort of question on the debt number that we have, which is roughly around 2,300 crores, which is almost same to what it was maybe about 9-10 months back. So we put in 330 crores in these 9 months that have gone by on capex, on growth capex, and only 30 crores increase in debt. So clearly the internal accruals of the cycle that's turned is able to support the capex plans to a large extent. We do expect the debt will peak out at about 2,800 crores about sometime in the next coming financial year, and then start tapering down very rapidly, because a lot of the assets come to fruition.
Okay. One quick follow-up again on the revenue streams, if you will. Now, we've seen how the wedding season has become a bedrock of sorts for the hotel space, because everybody's comfortable doing that. One of your peers is building out a chain of eating houses as well. Maybe you were doing something similar too. You might have some other plans too. What I'm trying to understand is, do you foresee that the percentage of revenues coming in from hospitality versus room rates versus maybe some other streams that you might be adding will look materially different 5 years out than what they're looking right now for you?
Look, I think majority of the business will still come out of two segments, which is the big individual business travel and the MICE segment. And business travel includes domestic and international. A couple of our hotels are very big with large banqueting facilities and large lawns. They will continue to drive weddings and other MICE events in a big way like they did pre-pandemic. You're right, wedding segment has grown multifold, especially in the leisure destinations. Right now, chalet doesn't have a leisure asset. In spite of that, I think all the 70 auspicious days that we have for weddings in India tend to get filled out in both our JW Marriott Sahar and the Westin Powai. These are large hotels. The Powai Hotel is almost 773 rooms, amongst the largest banquet hall in the city, and lawns which are massive. Similarly, in Sahar, we've got almost a similarly sized banquet hall and very large lawns to cater to this wedding demand. Bangalore, Hyderabad, less so, driven a little bit by location and the size of the banqueting facility that we have, and the other hotels are small. But having said that, weddings is still somewhere between 100 to 200 crores of revenue for us, even now, which is not a small thing. We don't ignore that. We'll continue to leverage and grow that segment. In fact, we recently did a massive event around Shadi by Marriott in one of our hotels, which has gained a lot of eyeballs. And I think that's going to drive the performance from there onwards.
Hence my question, really. But okay. Final 30-second answer before we leave you, Sanjay Sethi, at least from mine. I don't know if Abhay has one more question. But do you reckon these eye-popping statistics on results every quarter, some quarter there is a multi-decade high or multi-quarter high EBITDA, some quarter it is something else. How long does that continue for you? Let's assume.
So look, our growth has been on the back of like-to-like assets. We've hardly had any additional inventory coming into play when we look at our numbers, this year versus say 3 years back, right? And the growth has been robust. So from now onwards, we'll get growth, of course, which will be significant double-digit growth on existing assets, but we're also getting new assets and new inventory coming into play in the coming quarters. So on the back of that, the growth rate will continue to be very robust and strong.
Okay, great. We'll leave it at that. Sanjay, thank you so much for taking the time out and being with us. Much appreciated.
Thank you, Neeraj. Thank you, Abhay.
Thank you.
Well, viewers, that's the view from Sanjay Sethi of Chalet Hotels. And you heard it from the horse's mouth. Extremely confident about how the rate of growth might be. Newer assets coming into play as well. Abhay, what does this strike? You've heard some other companies as well, with Sanjay Sethi. What is your inherent thought about how long can this cycle continue?
Yeah, I think, what I would like to say, and the first question that you asked, Sanjay, I think was very pertinent, Neeraj, which was about how strong can pricing stay? Because right now it's just driven by demand and supply. There is so much of demand and people are, being inelastic. But, I don't think this is a situation that can stay forever. And when somebody travels, hotel cost is one part of the budget. It's typically about, let's say, 1/3 or 40% of the total cost. There is still air travel cost, which is also going up. There is a local tourism cost, which is also going up. Eating out, food cost, there is inflation. So when you put all these things together, there is going to be a point where the price will start pinching, and people would think about at least on the leisure travel where there is higher elasticity. Corporate travel is still a little more inelastic. So I think this kind of price rises that we have seen, I don't think they're going to continue for very long. And profitability is already showing. Companies like Lemon Tree are guiding for a 50% EBITDA margin. ISCL is guiding for a 40+% EBITDA margin. So you can see that EBITDA margins are already at cyclical peak. Cost efficiencies are priced in. Room rates are, occupancy is going up. So I think the delta performance from pricing is pretty much done. Now it's going to be more of occupancy and adjacencies, as you said, that, look, what else can you do other than room tariffs? That is going to come in. And that is where chains that are wider dispersed across verticals, luxury, semi-luxury, budget, mid-scale luxury, those will probably do better than others. But at the same time, the risk also is that people get very attracted by these supernormal cyclical profits and jump in. And though there is, it takes, as Sanjay said, 4 years to set up a new hotel, but there are enough existing hotels that could be acquired and brought on stream very quickly, within like 6 months. So those are the challenges the industry will face. But I would still say that overall, it's a very, very sweet spot that the industry is in.
Just one final question, Abhay. Within that space, there are different models. Indian hotels across the chain, as you mentioned, and an asset-light model. Lemon Tree, asset-light, but not at the premier end, slightly below. And Chalet, an asset-heavy and a slightly differentiated model. There are some other smaller hotel chains as well. What do you prefer as an investor because you've looked at this space for so long. Let's assume somebody's wanting to invest for 2-3 years. What do you prefer as an investor?
Yeah, so if you look at the data, Neeraj, the share of pure luxury has been falling over last 7-8 years in the total rooms available. Is fallen from about 25% to 16%. And on the bottom side, you have something called mid-scale economy, where the ratio has gone from 10% to 25%. So you can see that there is a change as the new rooms are coming up. They are catering more to higher, occupancy rather than higher room rate. And I think that trend is going to continue. So any chain that has a balanced portfolio, let's say 10,000, 12,000 rooms that are adequately spread across these different verticals. So you're catering to all kinds of travel segments, inbound, foreign, domestic, leisure, corporate, domestic tourism. I think those chains will do well because they will be able to flexibly respond to any opportunities that come their way faster than a chain that is catering to only a particular segment. So and that is what will help them become a long-term strong player in the hotel industry. So that is what our bet is. Of course, with that comes in this industry very, very important, two important things. How do you allocate capital sensibly to assets? Because those are the bets you are making, that whatever money you are putting up is going to yield a high IRR on that property. And second, never take your eye off cost efficiencies. You have to keep driving. You have to keep making sure that your room staff per room ratio stays at 1 or below that. Use those efficiencies to create those supernormal cash flows that will help you in the downside.
Okay, viewers, that's so much dope for understanding where to put in the money in the hotel space. But keep in mind the caveats that Abhay Agarwal spoke about. I think that should give you some food for thought as well. Research before you invest. That's what we would like to say. But Abhay, thank you so much for sharing some wonderful insights on this space on an inaugural episode of Insight.
Thank you, Neeraj, for having me. Thank you to the team.
Pleasure was ours. And viewers, thanks for tuning in. We'll be back next week with yet another insightful show.